Good evening, guys. It is February 14th, 2024. This is Ken at Tortoise Capital. This is the book club office hours for book one, Foundational Trading. So we are right here, session 6. Stand by. Right, we were just checking one sound feature, so we're okay. So we are in session 6. It is February 14th, 2024. Today we're looking at pages 177 through 189. This is section 11 in the book. And we're taking a look at towards trading tool examples. This part of the book was written by Phil. And what we're really doing here is taking a look at an example of a framework at a broker. And going to take a look at some tools and concepts that we use, what they look like on the on a dashboard, and then making that come to life, hopefully, with some examples that are connected to our core concepts. Previously, we've gone through, the top-down approach to the sniper, which we started at the strategic and the planning level, went down through the book organization, talked about challenges, references, and inspirations, top-level concepts, a broad view of a strategy to trading, and then a specific system in the Kata challenge. And then in this, we were also talking about ways to start acquiring our knowledge and systems in a continuous learning process. And so now we're starting to widen the aperture. Again, we're going to start moving back towards broader approaches. So this one is looking at dashboarding and infrastructuring. Section 12 is a collection of many different battle drills, processes, formulas, models, concepts that come from our ecosystem of learning that you can plug into your systems and strategies and your personal psychology wherever you see the need for it. So this is sort of like component parts from the tool room, I would say. In section 13 on March 13th, a month from now, we'll take a look at 10 different examples of traders who have been applying all this stuff in their own personal trading. And then section 14, which is session 11 on the 20th, is a chance to talk about your personal steps going forward. And then on the 27th, after you've had a week to think about your personal steps going forward, I'll do one final wrap up of personal learning strategy and application strategy. And that's what the course looks like going forward. All right, so I want to start as usual with the Cornell note sheet for today. This is the club meetup, session 6, Feb 14th. Those pages, which is session 11, the authors, Phil. This isn't, again, this is it's connected to infrastructure that Phil and Griff coded up, and they are specifically looking at the Thinkorswim platform, which is TD Ameritrade's platform. We have the same coding and dashboarding available also in TC2000. Significant portions of the swing trading and sniper trading have in Edge Raider from Chris White, and then some folks have put together a package that's available in TradingView. I personally use Excel for all of my brute force calculations and model development. And then I produce printed daily reports that we post on Patreon, which sends everything out in a group email, and then also weekend reports. And then I also convert the indicators and whatnot that I use into my own broker's platform, depending on which instruments I'm trading. So I convert, the trading dashboard into that. But I like doing work in Excel, just habits of a lifetime. But no matter which platform you're using, it's really all the same concepts, just expressed in your platform. I know some guys have done this in Ami Broker, and guys that are using it in Ninja Trader as well, and on so let's see, I know there's some other platforms. Anyway, so we're going to take a look at some keywords here and concepts in a minute. I wanted to start with what is the OWL bundle, and it covers it on page 177. So the collection of traders that uh, help me write the book and who are in contact with each other on a daily and a weekly basis includes me and my brother Bill, Phil and Griff, Bill Scheit, Jeff Bocasio, Sunal Darbar, who does certified hypnosis training out of the UK, Luke Crawford, and collectively that group of traders we call the OWL Group in honor of my dad. I'm one part of that. My part of that is the tortoise and I guess the sniper. But all these other guys have been taking the traditional trading patterns, systems, and concepts, and through research and development and practice and coaching, have turned it into their own personalized version of what it is that we do. So there is a real strong sense that we all share a given foundations. It's built on language and concepts, and supported by indicators, and then basic systems and strategies. But once you get into systems and strategies, each guy kind of has adapted it to their own unique strengths and weaknesses and circumstances. So we are tied together from this common information, which is what we have been trying to document through book number one, in which we work together on a continuing basis in our research program, which we completed in December 2023, which is available as a workshop with a lot of great reference material, lifetime access to that. If you, of course, there's about 100 hours of research and evidence presented on a big variety of trading systems, concepts, back tests, trading practice, and all that in the research weekend. So the OWL bundle then is Phil and Griff's implementation of these indicators and strategies and whatnot on the Thinkorswim platform. And the purpose of the chapter is to give an example using that Thinkorswim application to demonstrate the various capabilities of a given trading platform, how to find and execute trades using our top level process of plan, prepare, execute, and assess, which we've talked about at length in a previous session. In page 178, it gives an example of how to take a population, if you had a population of symbols, and that represented like your particular herd, like you're going to pick from among these different symbols and targets which ones that you want to further refine into a trading frame. And the idea being that you would specialize in all of the symbols. Like if I have personally about 60 symbols in my personal watch list that I'm always prepared to trade. And then when I go through my planning process, I might have isolated those three as primary candidates and then turned those into a prepared trade frame. And so the process of plan, prepare, execute, and assess is really learning how to manage your particular symbols of expertise. And we teach how to develop your personal watch list. Like I like to take what I call the world market model, which is, North America, Latin America, and South America, Asia, Asia less Japan, and Japan, and China, and all the different countries over here, and then Europe, and then emerging markets. And then I like to have members of all of those regional and geographic areas inside my population. And I also like to look at a lens of large cap, mid cap, and small cap, and make sure that I have elements of all of those in my target population. And I also like to take a look at value, growth, and blend. So I'm using the Morningstar style box to ensure that I have membership of all these different categories, both globally and conceptually, inside my population, so that no matter where leadership is winning in the world, I've got relative strength leaders popping out at me. I also have things that are lagging in there that I can pick if I want to do value trading. And so this allows me to slice and dice a working sample of the entire world market. So instead of having to study 10,000 stocks and 5,000 exchange traded funds, I can take with a sample of 60. I have a reason to believe that every day I'm going to get multiple symbols that are ready to trade tomorrow that I can prepare and rehearse. And so when we think about trading from a watch list, as described on page 178, what we're really talking about is having a nice herd of symbols and then having a set of filters and setups that allow you to scoop out of here the things that are ready to trade. And then we use the prepare portion of our process to turn those into effective trading frames and then rehearse those so that we can execute in a smooth way on the next day. Um, Something I want to emphasize is this idea of market condition essentials on page 179, which is a discussion of how we look at different ways of classifying the market. And the reason we do that is because research shows that for a company that you want to trade, about 50% of its performance is coming from the market itself, especially when you're selecting symbols like we do that are strongly correlated to the broader market. Like we pick large cap stocks in the US and in a few global. So that if the market is up, 50% of the movement of that symbol is derived from its fact that it's inside a market that's moving up and down. And then about 25% of a symbol's performance can be related to the sector that it's in. So it turns out that if you get the market and the sector right, then you've accounted for about 75% of the movement inside a symbol's uh, daily performance. And that leaves about 25% for the company itself. So you think you're trading the company and its posture, but really there's a large element of its work is being performed by the sector that it's in and then the market itself. So That's why we like the top-down approach, because if you get the market and the sector right, then you've got three-quarters of the problem solved, and you can be very efficient in your planning and framing, because the market and then just a few sectors give you such a broad view of all the other little symbols that you're working on. So when I'm putting together my portfolio, I like to have about 30 stocks in there that are arrayed across these different business sectors and geographic sectors and whatnot. And I like to have 30 exchange traded funds. And then these actually represent some broad market ETFs like SPY, the S&P 500, but also things like EEM, emerging markets, or XME, which is metals and mining and so forth. So it turns out that this top-down approach that uses a sample of markets and sectors and then targeted companies is a very efficient way to get a rapid, broad understanding of the market. That page goes a little bit into how we evaluate market condition. We take a look at things like in the sniper, we take a look at trade location plus volatility stats. Uh, that's one way. Another way is we have a specific market classification strategy that takes a look at bullish, sideways, and bear markets, and that's price relative to the 200-day moving average. We have definitions for that. And then we have volatile, normal, and quiet conditions. And so we've done research that looks at classifying today's market condition in one of those 9 categories, and then looking at the statistics of tomorrow's move. And based on that, we have information about whether or not it makes sense at the close to take a trade that we're in and then hold it overnight because of the statistical average follow through of the next day. Like, one of the things that we know is that when today closes in any bearish condition, whether it's bear volatile, bearish normal, bearish quiet, which is the rarest form of bear, all 3 of those conditions on average tomorrow are down days as measured over the last 20 years of daily performance. And we also know that sideways volatile and sideways normal on average is flat. So there's no extra advantage in holding a position overnight when you're in sideways conditions, because tomorrow on average is flat. So why take the overnight risk? Whereas it doesn't make sense to hold long positions overnight when tomorrow on average is down. So we know that about sideways and bears. And it turns out that there are 4 conditions in which the market on average is up, and that's any bull, which is bull volatile, the normal bull quiet, and sideways quiet. Those 4 market conditions, where the market spends a majority of its time, year in and year out, one day at a time, that those 4 categories lead to, on average, a favorable day tomorrow. That's just the statistics of it. So this information gives us an edge in deciding whether or not to hold an open position today for the overnight condition. So we know that. Now, we also use the 30-period regression line slope as a way to find interesting sectors that are outperforming or sectors to stay away from. We have some visual indicators that help us put various sectors on display so that we can see relative performance through time. As an example, this red line is symbol XLE, and the strength of its slope compared to its historical performance was it peaked right here at about 1.9 standard deviations above average. This is +1 standard deviation, that's +2. So there was a time at the time of making this chart that energy had really been outperforming almost 2 full standard deviations. And then it couldn't go up any further and it started to decay. Well, that change in the slope, we call the slope statistic or the slope stat, gave us an idea that this move up was over and that maybe that weakness could be tradable. At the same time, the XLF also was up around 1.9, but the large cap banks were continuing to outperform for another half a standard deviation. It got above 2 sigma, and then it was starting to roll over. So there are times when sectors in leadership positions are going up together, like energy and finance, and you should know that. And then there are times when the run is done, and then energy could be decaying while finance continues its leadership, and then something that was lagging, we're in third position, in this case, XLB, which is materials, uh, takes over the leadership position, and then it continues and accelerates its performance and begins to take on a leadership position along with finance. So all other things being equal, if we had trade frames that were going long, we like being, in this case, in finance and materials because the sectors themselves are outperforming the broader market, and therefore it's easier for other traders to continue to believe it's a form of risk management in the form of relative strength. Now, we also track in this case the SPY, which is this one in blue, which is stuck right here in the middle. So you can see that finance and materials are outperforming the S&P. The technology sector, which often tracks the broader market, had been lagging. It was paralleling it, but underperforming until it just recently, in that time period, became uh, uh, caught up to the S&P, and now it was in a posture where we wouldn't be surprised if the technology, which had been lagging, was going to start outperforming. So that little insight would tell us to start looking at members of our watch list that were in the technology sector, and then looking for leaders among the technology stocks that we track in order to find the things that were pulling the sector up. At the same time, XME, metals and mining, were underperforming and were showing no signs of recovering their strength. So now these become candidates for shorting. You could either look to get short XME, or you might be looking at symbols like Alcoa, Cliff Natural Resources, Nucor Steel, as individual companies that might be contributing to the underperformance. But when you put together this kind of market and sector classification and assessment, combine it with broader statistical treatments of the market, and then apply that to a portfolio which is carefully constructed of representative stocks and representative sectors, you can start using that information in an integrated way and start preparing your trading plan to take into account market, sector, and company performance, and use some of that cross boundary information to develop an integrated trading plan. Now, in all of these cases, when we have that watch list, what we're really trying to do, as described in page 181 and 182, are finding symbols that are in critical states or compound critical states. The simplest example of that might be if I had something like a 10-day look back period because I'm interested in swing trading on the short term, I might take a look at the the last 10 days, including today. So when today closes, that's now the -1 day. And if I go back 10 days, I now have a 10-day trading frame. And then I might find what was if my price action looks something like this, and it ended in a doji, a small range doji, I might now be able to find a compound critical state by uh, using our tortoise index to say, look at on a scale of 0 to 100, everything that's in the bottom 10%. So on a scale of 1 to 100, anything between 0 and 10 is going to be oversold and is in a critical state. And anything in the top 10% is overbought and also in a critical state. So I might say overbought and oversold. And then any of the members of my portfolio, remember the 30 stocks and the 30 ETFs, when I study them, if I see something that's oversold, I know that that has an increasing likelihood for a strong recovery move that's large range in a short period of time as a reaction to being oversold, or it could break down below the previous 10-day low, and now that thing is starting to collapse. So I don't know which direction it's going to go, but I know that if it starts uh, to gain, it has a good chance of making a strong move back to the middle of the range and beyond, or it may collapse. Similarly, if that thing had closed up in the upper 10%, I know that there's a greater than normal probability that if it breaks to the upside, that's going to be a big move in the short term, or it could be a reversion to the main trade. I don't know which direction it's going to go, but either one of these locations has the quality of being a critical state. If I if I use trade location plus a small daily range, so compressed volatility, I get a combination of both location plus volatility to develop a compound critical state. So one of the things that we can do is that we can define a set of rules and criteria to find candidates that meet our objectives for a critical state or a compound critical state. Now, what Phil has demonstrated here was that he happens to be looking at three criteria that he's using to narrow down targets, as described in the example on page 181 to 182. He was looking for range compression in the form of a doji, which is defined as if this is my average range, a doji has to be, excuse me, less than 80% of the average range. So the daily size of the daily range has to be smaller than that. So it would have to be in this range. And the open and the close have to be within 10% of the range. So it has to basically look something like this, where the open and the close are very close to each other, indicating that the buyers and sellers cut to a draw in a very tight compression area. So at various times, we can adjust that definition to adjust, how sensitive it is, but that's the default criteria that we use. So out of the dozen symbols that Phil was using it as an example, and he says you start with 12 because that's a good starting number because it balances the number of symbols that you want to see an opportunity and your ability to manage them conveniently. Like my number is 60 because I've been doing that for 30 plus years. But when starting out, 12 symbols is a reasonable place to start. And then when he looked at the criteria of which ones were in dojis and which ones had a favorable reward to risk ratio, that if we got the range stat move, which I'll explain here in a second, if we say a range stat is equal to the maximum reasonable intraday move. We've done statistics to determine how far could it move between the low of the day and the high of the day before it becomes abnormally large or irrationally exuberant. So what we're looking for is a statistical definition of what could be called the maximum reasonable intraday move. So if we say that's the that's the reward, we can then use a statistical measure to compute a given risk. Then if we take the reward and divide it by the risk the way we find them, then we're looking for symbols that are better than 2 to 1. This one didn't fire because it's rounding error. There were 3 of the 12 symbols that fired on a favorable reward to risk ratio. And then in using the sniper criteria, 3 particular patterns, he saw that 2 of them, in this case Tesla, met the criteria for the catfish pattern, and JP Morgan in the banking sector met the criteria for pure quiet. So that looks like 2 symbols that gave 3 reasons to believe that they are in a favorable condition for short-term trading, that the range compression in the doji means that yesterday was quiet and a breakout would catch people by surprise, which leads to either fear or greed, and then an exaggerated follow through. And the routine framing of a reward to risk gave it a better than 2 to 1 normal reward to risk ratio. And we could recognize 2 standard patterns that represent psychological states, like catfish pattern in the sniper turns out to be something that on the 150-day look back is in the bottom 10%. So it's brutally oversold on a long-term basis. And then on a 30-day look back, and that might be this period, it's also brutally oversold. So, and the volatility is quiet. 5-day volatility is very quiet. So what that means is we call that a catfish. That means it had plenty of opportunities to continue to fail, but it didn't. In fact, the volatility was really quiet. So like a big fat catfish, it's just up value on the bottom of the river here. And there's a good chance then that there is some value accruing and it could actually break out of the volatility to the upside and give us a surprisingly large move when it breaks out of the dojo. So the combination of oversold on 2 time frames plus small volatility gives us a favorable breakout. On the other hand, if there was some news that caused it to break down below the previous 30-day and 150-day low, that could be a surprising shock. And now the volatility could be broken to the downside. So now what we have is a symbol that's in a compound critical state, ready to make a larger than normal move in either direction in a shorter period of time. And that's why we love catfish. Now, similarly, the JPM is in what we call pure quiet. And with that one is the opposite of the catfish in many ways, that it's sitting right on the 50-yard line in terms of the 150-day and 30-day lookbacks. In fact, in both of those conditions, it's sitting right on the 50-yard line, meaning that, and it's quiet. So if the doji breaks out from here, it could move in a 3 to 1 reward to risk to the top of the look back period or to the bottom. So this is like a fence sitter, and there's no reason to believe that there's any panic. But if it comes out of quietude, like there's a new program of either buying or selling, then all of this static slumber, it's just sleeping in the middle of the road here, it could start with a small move and then becomes a breakout, and then momentum comes and gets larger. So the pure quiet combines a small volatility and a trade location that is smack dab in the middle of the trading, 2 different trading ranges So now everybody ignores that except we like it because it's a nice quiet move back towards an extreme. This is what happens after you get a reversion to the mean trade. If it sits there and it's super quiet, then the next thing could be a quiet breakout in either direction. So the main point of this discussion was simply to say that we can use rules and infrastructure and indicators to take a look at our watch list, check to see which ones fit criteria that are of interest, have that done automatically through our trading infrastructure, and then make a shorter list of things that need to be framed in the usual way, and then develop that into a tradable entity. Now, this one over here under system shows what can happen when you get symbols that have gone through a period of range expansion and then rolled over. These are the Z3 Bollinger Band lines. And now this was the point of maximum excursion and volatility. But now as price starts getting sideways here inside this tight channel, you notice that those lines are starting to compress to the point where they become abnormally compressed based on a statistical measure of how wide has this been over the last 200 bars, and then what was the narrowest ever was and what was the widest. And we can put statistics on that. And when something is abnormally quiet, we code that as abnormally quiet, and we turn the Bollinger Band to yellow. I'm going to draw it as orange so you can see it. And now what we have is a pinching of those Z3 Bollinger Band lines, what we call the Z3 pinch. And when it goes smaller than a statistically derived measure, we have an indicator that tells us how narrow does this have to be interesting. When the Z3 lines have pinched narrower than that, Phil and the boys have this color coded so it turns yellow and it gives you a visual alert. And what that means is that any breakout below that Z3 line now becomes a trigger for a short trade opportunity. And you can see the thing breaking out to the downside. And then here's another one where you take that Z3 pinch box and you say anything that breaks out below here is a short. And then anything that breaks out of that box to the upside, let me color that as green, is a breakout here. And we will typically use either the midpoint as our measured risk, or the far side, we'll use the whole V3 to Z3. So either one of those is an acceptable way to start framing your risk. So what we're doing is going from setups into a particular execution framework with a standard pattern that lets us execute the standard work for patterns. There's an additional indicator we talk about in the PSAR flip. We code the PSAR, parabolic stop and reverse, in such a way that when it flips, that also can be taken as a signal for a trade. Like when this one flipped here, that set up a potential trade in that direction. And that's discussed on page 184, especially useful on swing trades, but also is very powerful intraday. Now, the next thing I want to talk about is in the area of the market mosaic in the OWL bundle. It turns out that each one of these little rectangles is a parameter in what we call the market mosaic. So if I have the world market model is here like this in all its dynamic glory, and it has a bunch of different symbols in here that are zooming around, and some things are up and some things are down, so it's a place filled with furious activity. Well, what we have in the bundle is a collection of tools. Each one of these is a particular indicator or framework, and each one of these acts like a specialty lens glasses that allow us to take a look at all of this chaos in the market and then give us very specific outcomes, results, and measurements, and then we can pick and choose from among those to put together into a system that reflects certain symbols that meet our criteria. So the market mosaic and the owl bundle and really all of the infrastructure that we have allows us to assemble the toolkit that is use from the toolkit, assemble the tools that we need to do whatever job that is we want to do. So when you heard me talk about in a couple 3 or 4 weeks, when we take a look at the way different traders are put together, essentially what they've done is found the style and type and timing of trading systems that really resonates with them. Then they can pick and choose from among the toolkit to assemble their own little dashboard. And then, like in this case, picking 3 particular indicators to give you a working list of trades to frame. Griff's synthesis is his observation of how having the computer, your automatic, untiring, never failing administrative research assistant, brings efficiency to standard processes, because the instant the market closes, you could have 5,000 or 10,000 symbols being evaluated for whatever set of criteria it is that you want, that you might want to specialize in. Maybe there's just one set of criteria that you like, and maybe you want to look at 500 different symbols. You can't do that flipping individually through. But if you've got the infrastructure, untiring, error-free, it'll give you just the things that you want, and then those can be set up to create the trade frame that you want automatically and save you all of the time and effort of building out your template. In Griff and Phil's notes to themselves, they're taking a look at how the PSAR Pflip Alert can be added to our latest research discovery, and that is that using a 3-day bar turns out to be a really powerful way to swing trade. That when you're going from day to day, it closes here and opens there, you have to contend with this gap. But if you compress all 3 of those days into a single bar that opened here and exited there, you get a single bar, and then that becomes a very smooth way to look at a slower moving time frame. And it turns out that the PSAR Pflip Alert is a really powerful way to trade using the slower time frame. 3 days we like because it's slower and smoother than 1 day, but it's faster and more adaptive than 5 days. And that's really when folks are looking at weekly candles. We get to make, in 30 days, we get 10 bars of 3 days per bar, whereas this guy only gets 6 bars of 5 days. Each is 30 days, but I get twice as much information as this guy in order to make a more nuanced decision. And because the gap is less important because of the size of the time frame, it's actually a smoother way to manage swing trades. So you get this trade-off of using 3-day bars turns out to be a very effective way to harmonize the advantages of daily bars and weekly bars without falling prey to their shortcomings. All right. So that covers the note set that I wanted to do. Now, what I want to talk about here, we got about 10 minutes remaining or so. I want to take a look at some of the key indicators that we use that are found in all of these patterns. All right. The first one is the risk Z. So the risk Z comes from some academic research which says that if you compare the 10-day moving average of the VIX index, which is a measure of implied volatility in S&P futures contracts on the Chicago Board of Trade, this is considered to be a measure of the anxiety of pro money managers. And this allows the VIX reading is a measure of how much insurance are they trying to buy. And the more guys trying to buy portfolio insurance against the sell off drives the price up, which then is used as an indication of rising anxiety in the chattering class. And if you compare the fast moving average, the 10-day, to the slow moving average, the 30-day, what you find is that the normal condition of volatility is in this kind of a band. And then periodically you get an amazing uptick of volatility when the VIX explodes. And then when the crisis is over, you get a long, steady decay back to the normal range. Well, it turns out that if you use a moving average of this VIX indicator, that there comes a time when the VIX has peaked and then rolls over its moving average, and then this is an indication that this is very bullish because you have declining volatility after the crisis. This is the crisis and the transition period. So once you've cleared those hurdles, you have very bullish conditions. So for us, the risk Z indicator is a statistical treatment of the relationship between the 10-day and the 30-day moving average of VIX, which gives us a posture on short-term trading opportunities based on volatility statistic of the market. So it's a statistical treatment. We cover it in our foundations course, but it's another way that we use market classification as part of the market mosaic in order to find moments of advantage when it comes to shorter term trading. That's all I want to say about that one. It's easier to use than it is to explain. I'll say it that way. But it turns out to be one of the most powerful edges that we've had for over 15 years. We've been using it very successfully. The next one is a 30-period regression line slope, and that's discussed on pages 180 to 181. Now, it turns out that when you have price bars, and let's say that there's 30 of them in here, the 30-period regression line, which I'm going to draw in blue, is the best fit line, which minimizes the distance to each of these different points. So I tried to mathematically, there's a way to draw that so that it is the best fit. And one of the things that we can say is that if I had a zero line or a perfectly flat slope, that the amount of upward price movement, the more upward movement there is, the steeper that slope line will be because price is rising. So I can actually measure this angle. What is that angle? And then I can go back 180 days and I can find the maximum, the minimum, the average, and then plus or minus one standard deviation. And then I can start classifying the slope of that regression line to measure the strength, the trend as a statistical z-score. Now, for those of you playing along at home, a z-score tells you how many standard deviations away from average the current reading is. So if I measure this angle and I put it on that scale of the last 180 measurements, and it was exactly one standard deviation better than the long-term average, it would have a z-score of 1.0. If it was 2, it would have a z-score of 2. If it was exactly equal to the long-term average, it would have a score of 0. And the same thing to the downside. So now what that lets us do is do two things. It lets us measure the performance of this instrument's trends up and down over a time period. And when you put that on a z-score time series, and you say, there's my average and my plus or minus one, that gives you a boundary of normal. And then as you trace that performance through time, you can say, oh, it's really underperforming its historical norms. It just turned at a position from abnormality, and now it's getting better, and it goes through normal until it's exceptional, and now it's back into normal. So we can actually see the life cycle performance of that target as measured by his slope statistic of the 30-period regression line. It turns out that 30 periods is a good thing to measure because you need 30 data points in order to establish standard statistical descriptions, so mathematics. So one thing we can do is understand our target through time by doing a time series of the z-score. The other thing that we can do is we can compare two different symbols or 10 different symbols. If I wanted to compare the S&P against emerging markets against the Euro-Asia large cap blend versus U.S. real estate, I could take a look at the current reading of the slope statistic of all four of those and then rank them on the basis of best to worst, and then I could see which ones are worse than the S&P and which ones are better. And then depending on which direction I want to go, I have a sense of how both the market and the sectors are arrayed on the basis of a relative strength comparison. So that's how we use the 30-period regression line slope. We take that a step further and we actually take a look at the z-scores of the 10-period, 30-period, 90-period, and 270-period regression lines in order to understand the fastest and the slowest of these forms of moving averages, to take a look at four different demographics of aggressive traders, conservative traders, aggressive swing traders, and conservative position traders. And then by comparing the fast against the slow, we can see the difference of opinion about fair value between traders and long-term buy and holders. And that gives us a way to start understanding price dynamics over time and the psychology of different populations of market traders. We cover that in the foundation course at length. This is maybe our most powerful advantage, and especially when you combine it with standard techniques for identifying targets and framing trades and rehearsing standard patterns, you get the ability to rapidly find stocks that are postured for surprisingly large moves. Now, the next thing that we do with our infrastructure is understand reward versus risk, and then this is really for our intraday and swing trading one day at a time techniques, where we take the reward as measured by the range stat, which is again the maximum reasonable intraday move. So if it opened here and then it started moving up, we would say, well, how far up the stack today could it go? We take that statistical measure from the low of the day and we say, this is the largest reasonable upside move. And so if I have a risk box like this, and I can find 2 units of reward inside there, I now have a 2-to-1 reward to risk ratio intraday that allows me statistically to justify taking that risk. It also works to the downside. So when you have the opening, you have simultaneously a new high and low of the day. So we know as soon as the market opens that the largest reasonable move in either direction consists of the range stack. And then we know the size of the risk box that we can use on the basis of yesterday's range plus a small buffer. And we say, if I use that as my risk, if I can fit 2 of those inside that daily range, then I know that I can use that wide measurement of risk in framing my trades. The last concept I'll talk about here is the idea of pinch and super pinch. So one of the things we like to do right from the open is put a nice bracket on our best tradable opportunities. And then we like to trade the breakout in the direction of plus or minus the range stat as I just described. And so we're going to, if it breaks out to the downside, we're going to be short here at this red line. I'm sorry, that should be red. If we get short on the breakout, when it moves 1 or 2 units of reward in our direction, at some point, I get to get my stop below my entry so that I can lock in that kind of a gain. Well, we would keep that until everything calms down, and then we get a period of abnormally tight sideways quiet channel. Now, we don't trade inside this here because that's where the crocodiles live. We call that crocodile river. But if that large directional move calms down, you'll see the Z3 Bollinger Band lines will converge into what we call the pinch. Now, if that turns out to be within our statistical measure, we can now say this thing is in a Z3 pinch condition, which means that these lines have pinched enough so that the breakout is now once more an attractive trade frame. What this Z3 pinch concept does is it allows us to observe the price calming down, but keeps us out of the crocodile river until it is pinched so much that we have an abnormal condition, and now the breakouts can be played as long as there's enough time during the day to express that next move. This also can be done on a swing trade basis as well. If you had a nice breakout from a consolidation zone and it went up here and started to consolidate and sell off, and now it's consolidating once more, well, this has compressed enough, we could put a breakout box around that based on statistics and then play a move in either direction. So this is what we mean by pinch. And then the super pinch occurs when we take those 4 regression lines, and when the 10, the 30, the 90, and the 270 moving regression lines have also moved inside here, we have what we call a super pinch, because all 4 of those demographics all agree that this is a fair market value price, and it's super pinched, and then a breakout from there means that all 4 of those demographics are ready to start trading. So the pinch and super pinch is the technique that works for us on every time frame for intraday as well as swing and position trading. It is a fractal concept, and it's an advanced sniper pattern. Normally, we wait in the sniper for a harsh winter to allow us to begin to play the supported spring crossing. If that fails, we play the collapsing dragon. If the supported spring crossing works, we can keep buying on dips all the way up using the COD2 pattern. And all 3 of those patterns are how we play directional trades. But when the directional trades suddenly become sideways, then we can start using what we call the pinch and super pinch, which is a strategy that we describe on pages 184 and 185. So that's what I wanted to cover for tonight. Depending on which infrastructure that you might be using, your infrastructure might look something like this, where if you're using EdgeRater or reading my daily reports, where you take a look at, this is from today, in fact, I'm looking for auto framers, and that is I'm looking for things that test out on better than 2 to 1 as measured by a mechanical entry, a mechanical risk, and a return to the 10-day high. And based on that framing data, I can compute the reward to risk ratio, and anything better than 2 to 1 tells me I have a swing trade possible. And today, the best one looks like McDonald's at 5.4 to 1, and then Caterpillar is still at 4.3 to 1. And then I have the spreadsheet compute my standard work for the size of the risk, and it computes what my target dollars would be if it were to return to the 10-day high, it computes the size of the risk box, and then that allows me to compute the reward to risk. And so this is an example of using infrastructure to auto frame trades on the basis of location and volatility that we use as part of our daily planning and preparation procedure. And since the spreadsheets or the bundles do this for you automatically, you don't have to. So you only have to look at the charts that meet your criteria here. Where if you're looking to do it on an intraday basis, these are the ones that have the best range stat compared to standard risk, and it's the same ratio, but for intraday trading. So it turns out that for tomorrow, McDonald's is a great swing trade at 5.4 to 1 reward to risk. And then intraday, it has a 3.5 to 1 intraday reward to risk ratio. So this could be a compound trade for me tomorrow in McDonald's. Caterpillar is also very favorable at 4.3 to 1 as a swing and 2.3 to 1 as an intraday trade. So the point of this one is to say that our standard work is expressed in a variety of different brokers and their trading platforms. Those are available. We have ways to teach that. But once you get the rules down, you can pretty easily develop these into your own preferred trading platform. And that's what all the guys that have been our students and that have produced these packages have done. The advantages of doing this is that the admin work is done for you. It saves you literally hundreds, if not thousands of hours of brute force coding work to do that kind of work. And then the guys that are in Phil and Griff have what they call the owl bundle users group, and that's guys that all have the bundle, and then they get together in an accountability group to share ideas and training and develop new filters. So that's a way that you can use the power of masterminds and accountability groups to improve your performance. The real edge for us consists of being able to define the elements of standard work, use the power of simple descriptive mathematics to give us a disciplined approach, finding, framing, and trading targets according to the unique insights that we have developed for support of our particular style trade. Because these are unique insights into looking at the market, they are robust because they're kind of unique to us. And then the pattern recognition that we get from the sniper and pinch and stretch gives us unique ways of rapidly framing in both directions, which is really important in dynamic and volatile markets. Right. So that's everything that I want to cover. There's literally hundreds of hours of trading education available in the Foundations course. And I should just say, this is not a cynical effort to sell you. I'm just saying that for 35 years, we have accumulated our understanding and our patterns into the Foundations course. With the Foundations course, you get lifetime access to all the material as it's developed now and all future updates. Like we have office hours twice a week where I answer questions from the field, and then the recordings of those go into the Foundations course as refinements and deeper understanding. So it's a living, breathing, accelerating course. The price of that thing is $29.97 for a lifetime. And again, hundreds of hours of material. It will never be less expensive than that. If you have I should say, unless you have the Foundations book, in which case I think there's a $500 coupon in there, which in a moment of weakness, I decided to put in. That's the best deal going, I think. And then you have the ability to ask questions uh, for the weekly check-ins, and because we record them and store them in the workshop online, you have access to, and you can download those too, so you can protect yourself against whatever information uh, disappearing or whatever, which won't happen, but some people will worry about that. By the same token, there are guys that are lifelong traders with me that do small group coaching, which is where they're actually turning their understanding of the foundational elements into their own systems, which then get briefed during our research workshop each year. That's what I consider to be advanced trading. That is available to you as well. But I require people to be foundation students, because there's just too much information that's already very good. There's no reason to pay for small group coaching until you've mastered enough of the foundations course to be working on your own systems and strategy. But if you're interested in that and you're in the sound of my voice, just get a hold of me and we can talk about that. I should also say that Griff and Phil, who helped co-write this book, have taken a subset of the foundations course, and they've turned that into COTA 2 challenge, which is one specific system and then one recipe for adapting a system. And then that is the COTA 2 challenge course and the applied system development course. It teaches you how to create or adapt your own system. It uses the COTA 2 challenge system as an example of how to build rules. And at the end of it, you get a deep understanding with coaching of how to use that system, which is fractal and can be used intraday as well as for swing trading. That's a nice way to get started into the world of the foundations course, I should say. And it's a important subset of the foundations course, a small but powerful part of that. That's a good way to get started, by the way. And if you're interested, just get a hold of Phil and Griff, um, and they can lay that out for you. I think they're getting ready for a new cohort coming up in a couple of weeks. That's everything that I wanted to cover for today, and we'll get this published and posted. Uh, into the online workshop. I appreciate your kind attention. And again, if you have specific questions about any of the upcoming materials, you can send me an email, and I can make sure that we get it added into the presentations. Thanks for your kind attention. Take good care, and we'll see you the next time we see you.